There's a specific playbook for destroying a global reserve currency. It's been executed successfully 3 times in the last 400 years. The Dutch guilder, the British pound, the French franc, all dominant, all seemingly permanent, all replaced. And right now, in 2026, China is following that exact playbook, step by step, decision by decision, executing the same strategy that has toppled every reserve currency in history. But here's what makes this different. They're not doing it through war, they're not doing it through sanctions, they're doing it through infrastructure, through commodities, through bilateral agreements that are happening right now, today, while the United States pretends it isn't happening. In January 2024, Saudi Arabia conducted its first oil transaction in yuan, not dollars. In March 2024, Brazil and China agreed to settle all trade in their own currencies, bypassing the dollar entirely. By November 2024, 30% of Russia's foreign trade was denominated in yuan, not rubles, yuan. And these aren't isolated incidents, these are stages. This is the pattern. And the United States has already lost control of the narrative. We're not approaching dollar collapse, we're watching it happen in real time. This is the story of how reserve currencies die, why China studied every previous transition, and why the infrastructure they've built over the last 15 years makes dollar dominance mathematically unsustainable. And it's happening faster than the Federal Reserve wants to admit. Before we dive into China's strategy, you need to understand what actually kills a reserve currency. Not in economic textbooks, in practice, what it means when the world stops needing your money. A reserve currency dies when it loses its 3 critical functions: medium of exchange, store of value, and unit of account. The dollar became the global reserve currency in 1944 at Bretton Woods for one reason: everyone needed dollars to buy oil. After World War II, the United States controlled global oil flows, dominated manufacturing, and backed the currency with gold at $35 per ounce. If you wanted energy, you needed dollars. If you wanted to trade internationally, you needed dollars. If you wanted stability, you held dollars. But here's the critical detail most people miss. Reserve currency status isn't permanent. It's conditional. It depends on network effects. The dollar is valuable because everyone else uses dollars. The moment that network fractures, the moment alternatives emerge, the advantage reverses. Suddenly, the dollars you're holding aren't demanded by everyone. They're flooding back home. And when trillions of dollars held overseas return to the United States, the currency doesn't strengthen. It collapses under its own weight. That's not theory. That's what happened to Britain between 1945 and 1976. The pound sterling was the global reserve. British debt was denominated in pounds. Trade was settled in pounds. Then the United States offered an alternative. The dollar, backed by gold, backed by oil, backed by military power. Countries switched. And the pounds held in foreign reserves came flooding back to Britain. The result: devaluation, inflation, currency crisis. The empire didn't lose the currency. The currency lost the empire. And China studied this transition in excruciating detail. Let me show you exactly how China reverse-engineered the playbook. In 2013, Xi Jinping announced the Belt and Road Initiative. On the surface, it looked like infrastructure development. China would finance roads, railways, ports, and power plants in 152 countries across Asia, Africa, and Latin America. Western economists dismissed it as debt trap diplomacy, unsustainable lending that would backfire. But here's what they missed. The Belt and Road Initiative wasn't about profit. It was about currency infrastructure. Every port China built, every railway they financed, every power plant they constructed created dependencies. Countries that borrowed from China owed yuan-denominated debt. Countries that traded through Chinese built ports settled transactions in yuan. Countries that relied on Chinese technology needed yuan for maintenance and upgrades. This wasn't charity. This was network construction. China was building the physical infrastructure required for yuan to replace the dollar as the medium of exchange. And they did it over 12 years while the United States was distracted by wars in Iraq and Afghanistan. By 2024, China had spent $1 trillion on Belt and Road projects. That's not a loan. That's not aid. That's currency network capitalization. And it worked. In 2015, only 2% of global transactions were settled in yuan. By 2024, that number is now estimated at around 13%. Still behind the dollar at 58%, but growing exponentially. And here's the acceleration point. History suggests that once a currency crosses roughly 20% of global transactions, the network effect reverses. Holding dollars becomes riskier than holding yuan because fewer people need dollars for trade. We're 3 years away from that threshold, maybe less. But infrastructure alone doesn't kill a reserve currency. You need commodities. This is where China's strategy gets brilliant. The dollar became the reserve currency because oil, the most critical commodity on earth, was priced exclusively in dollars. The petrodollar system, established in 1974 between the United States and Saudi Arabia, created artificial demand for dollars. Every country needed dollars to buy oil. Even if you hated the United States, even if you were sanctioned by the United States, you needed dollars for energy. China couldn't attack this system directly, so they built an alternative. In 2018, China launched the Shanghai International Energy Exchange, the INE. This was a yuan-denominated oil futures market. For the first time, oil could be purchased in a currency other than dollars, and that currency was convertible to gold through the Shanghai Gold Exchange. Think about what this means. A Saudi oil exporter can now sell oil for yuan, convert yuan to gold, and never touch dollars. The transaction bypasses the US financial system entirely. No SWIFT network, no Federal Reserve oversight, no dollar intermediation. When Saudi Arabia conducted its first yuan oil transaction in January 2024, it wasn't symbolic, it was structural. Because once the precedent exists, once the infrastructure is proven, the question becomes, why use dollars at all? And China didn't stop with oil. In 2023, they became the world's largest importer of natural gas, soybeans, copper, and iron ore, all critical commodities. And in every negotiation, China offers the same deal. Sell to us in yuan, and we'll provide financing, infrastructure, and long-term contracts. Countries are accepting because the alternative is dollar dependence, and dollar dependence means exposure to US sanctions, Federal Reserve policy, and currency volatility they cannot control. By 2026, 47% of China's commodity imports are settled in yuan. That number was 12% in 2020. The trajectory is clear. Now here's where the strategy becomes irreversible. China has built the digital architecture for a post-dollar world. In 2021, the People's Bank of China launched the digital yuan, the ECNY. This isn't cryptocurrency. This is a central bank digital currency, fully backed by the Chinese government, programmable, traceable, and designed for cross-border settlements. The digital yuan allows instant transactions between central banks without intermediary correspondent banks. No SWIFT system, no dollar conversion, no delays, no fees. For countries that trade with China, and that's 128 countries as of 2024, the efficiency gain is massive. A Brazilian company selling soybeans to China can receive payment in seconds. The transaction settles directly between the Central Bank of Brazil and the People's Bank of China. No dollars, no delays, no intermediation. And because the digital yuan is programmable, China can attach conditions. Smart contracts that release payment when goods are delivered, automatic conversion to local currency, built-in trade financing. The system isn't just faster, it's structurally superior for bilateral trade. And here's the critical detail. The United States has no equivalent. The Federal Reserve is still debating whether to create a digital dollar. China deployed theirs 3 years ago and has already processed over $250 billion in transactions. The infrastructure gap is widening, not closing. But the real genius of China's strategy isn't what they built, it's what they dismantled. For 50 years, the United States weaponized the dollar. If you opposed American policy, you faced sanctions. If you challenged American interests, you lost access to dollar clearing systems. Iran, Russia, Venezuela, North Korea, all cut off from SWIFT, all unable to use dollars for international trade. The United States treated the dollar as a weapon, and every sanction taught the rest of the world a lesson. Dollar dependence is a vulnerability, and China offered an alternative. When Russia was sanctioned in 2022 after invading Ukraine, China didn't join the sanctions. Instead, they expanded yuan-ruble trade. By 2024, 95% of Russia-China trade was conducted in yuan and rubles, $0. Russia's central bank now holds 30% of its reserves in yuan. That's a permanent structural shift. And it's not just Russia. In 2023, Argentina, facing dollar shortages and inflation, negotiated yuan trade agreements with China. In 2024, Indonesia, Malaysia and Thailand began settling trade in local currencies and yuan, bypassing dollars. These aren't small economies. These are the 10th, 16th and 29th largest economies on Earth. And they're all reducing dollar exposure simultaneously, not because they love China, because they fear dollar weaponization. The United States created the incentive structure. China just built the alternative. And every sanction, every freeze of dollar assets, every threat accelerates the transition. Here's what this looks like in practice. In 2010, if you were a central bank, 70% of your reserves were in dollars. It was the safe choice, the liquid choice, the only choice for international transactions. By 2024, dollar reserves had fallen to 58%. That's a 12 percentage point decline in 14 years, and it's accelerating. In just 2023 alone, central banks reduced dollar holdings by 2.5 percentage points. Where did that money go? Gold, yuan, euros, and increasingly bilateral currency swap arrangements that bypass reserves entirely. China has signed currency swap agreements with 40 central banks totaling over $500 billion. These agreements allow countries to trade directly in local currencies with yuan as the bridge, no dollar conversion required, and here's why this is the tipping point. Every country that signs a swap agreement, every trade deal settled in yuan, every commodity transaction that bypasses dollars reduces the demand for dollar reserves. And when reserve demand falls, so does the dollar's value. Not immediately, not dramatically, but persistently, inevitably, structurally. The dollar index, which measures the dollar against a basket of currencies, peaked at 114 in September 2022. By February 2025, it had fallen to 102. That's an 11% decline in 29 months. And the trend is continuing because the structural drivers, China's infrastructure, commodity diversification, digital currency, and sanction avoidance are all accelerating. Now here's where it gets irreversible. The United States cannot stop this. Not through policy, not through interest rates, not through military power. Because the mechanism China built doesn't require defeating the dollar. It requires offering an alternative. And once the alternative exists, once the infrastructure is operational, once the network effects begin, the transition becomes self-reinforcing. Countries switch to yuan trade because other countries are switching to yuan trade. Central banks reduce dollar reserves because other central banks are reducing dollar reserves. It's a coordination cascade. And the United States is watching it happen without the tools to respond. Raising interest rates strengthens the dollar short-term but accelerates the long-term shift by making dollar debt more expensive for developing countries. Lowering interest rates weakens the dollar immediately. Sanctions push more countries toward yuan alternatives. Diplomacy can't reverse 15 years of infrastructure China has already built. The Fed is trapped. Every move accelerates the outcome they're trying to prevent. And China knows this because they designed the trap deliberately. Yuan will account for 25 to 30% of global transactions. The dollar will still be dominant at 40 to 45%, but it will no longer be indispensable. And that's the threshold. Once you can conduct international trade without dollars, Once you can buy oil without dollars, once you can hold reserves without dollars, the question becomes, why take the risk? Why hold an asset that's being debased by $2 trillion deficits annually? Why depend on a system that can freeze your assets with a sanctions vote? The rational choice becomes diversification. And diversification means a dollar decline, not collapse, decline. Persistent, structural, irreversible decline. And here's what that means for the United States. Every dollar that returns home from overseas reserves is inflationary. Every reduction in foreign demand for treasury bonds raises interest costs. Every shift away from dollar trade reduces American influence. The advantages that made us powerful, reserve currency status, cheap borrowing, sanctions leverage, become vulnerabilities. The currency once demanded by everyone comes flooding back. The debt once absorbed by foreign central banks must be financed domestically. The system that funded American empire for 80 years reverses. And China doesn't have to fire a shot. They just have to keep building infrastructure, keep offering alternatives, keep expanding the yuan network while the United States debates, delays, and denies. The transition is already underway. The question isn't if, the question is how fast. And based on the last 3 years of data, faster than anyone in Washington wants to admit. This is the playbook. Infrastructure creates dependencies. Commodities create demand. Digital currency creates efficiency. Sanctions create incentive. And alternatives create inevitability. China studied how the dollar replaced the pound. They reverse engineered the mechanism. And they're executing the same strategy with more capital, more patience, and more precision than any previous challenger. The dollar won't collapse in 2026. It will erode 2% this year, 3% next year, compounding annually until one day it's no longer the global reserve, just one option among several. And by the time that's obvious, it will have been inevitable for a decade. The empire doesn't lose the currency. The currency loses the empire. China just proved you don't need war to win. You need infrastructure, alternatives, and time. And they have all three. Empires don't fall when they're attacked. They fall when the world no longer needs their money.